Well, joining us now is Tim Evans from Longleaf Trading Group. He joins us live from the CME in Chicago. Tim, hello to you. Thank you so much for being with us. There's been some suggestion that the falls that we've seen today are just off the back of Friday's rig count data feeding through and investors continuing to react to that. Just guide us through what you're seeing on the ground over there.
Hey, Natalie, nice to be with you today. Yeah, I mean, the rig count data that was released on Friday, I mean, it's been consistent with what we've been seeing for months. That U.S. producers are, continuing to invest in production for U.S. supplies. And, obviously that's a very bearish factor, but it's one that's been developing and picking up steam. Friday's number showed we're at the highest levels we've been since November of 2015, so it's significant.
We're seeing sort of a real range-bound price action when it does come to crude. Is that limiting options for traders in terms of, when to get on and off this trade?
Well, I think the range-bound activity just kind of reflects, the fact that you can make a pretty compelling case, being a bull or a bear in the market. We've really focused on the bullish kind of argument over the last month, 2 months really, as we were preparing for and dealing with the realities of what this production cut would look like. But at the end of the day, there's still a lot of bearish forces that are in the market that are providing good balance, to those underlying bullish forces. So it's created kind of a very tight, range-bound market environment. But, I think as the data begins to come in and continue to support or not support continued compliance by OPEC members, we're going to get an expansion out of this range. I think the tail risk really has increased on both sides of the market, both up and down.
So with that in mind then, Tim, aside from flipping a coin, what are some of your pricing forecasts then that you're seeing in sort of the near to midterm?
It's a good way of putting it. Sometimes it feels that way. Fortunately, capital markets are a little more advanced than that. They give us other options to utilize to take advantage of things that we see in the market. Definitely one thing that I see is that the volatility component of oil has, obviously fallen as we've gone into this trading range we're in. The oil VIX, the last time I left the office a little bit ago, was trading a little over 31 bucks. We feel, ultimately getting an expansion out of this range, we can get back to that $41.5, $42 level. So we think the volatility component of the market is really where the opportunity is.
Interestingly, to compare that certainly with comments coming through from the Iranian oil minister, Tim, saying they expect oil prices to remain around 55 US dollars per barrel this year. Producers, he says, will see prices in the range of $55 to $60 per barrel comfortable. Again, that sort of lines up a little bit differently with your own forecasting.
Yeah, and I think they're looking for kind of that balance exactly that I'm referring to. But, I think one point that's definitely worth noting is, compliance is one thing when a deal's working. But, if we're not seeing price support in crude oil, do the members of OPEC that are part of this deal continue to comply? Deals are easy to comply with when you're getting what you want from it. But, if the stated objective of that deal, is not giving the members what they wanted going into the deal, I think that leaves a much greater incentive for non-compliance at that point. So, I think that's something we all need to be, focusing closely on here as the weeks progress.
Now, just to switch focus ever so slightly, Tim, we are watching in the commodity space grain also. Prices here coming under quite a bit of pressure. Just give us a little bit of color around this story if you can.
Yeah, absolutely. We started off in the red. We gapped lower on the open last night, and selling has continued all day. And, I think really what we're seeing in the grain markets is what we're actually seeing in a lot of other commodity markets. The uncertainty in terms of these trade deals and what kind of impact that will have on, international grain prices, has the market on the defensive. Mexico is our largest importer of grain in the U.S., and China is a huge importer of U.S. soybeans. And it just so happens that Mexico and China appear, at least in my perspective, to be the kind of the targets of these renegotiations that the Trump administration is wanting to take on. So that leaves a big amount of uncertainty in terms of what kind of impact that'll have, on U.S. grain prices. And, markets are reflecting that here today for sure.
How do we go about then in terms of the supply-demand story? Because again, I believe that that's feeding through also into some of the soybean action that we're also noting at present. Is that the supply that we are getting through here?
Yeah, I mean, this year, well, that ended in 2016. I mean, we had a record crop in the U.S. for soybeans. A lot of acres, and we came in a little over 52 bushels per acre, which yielded a record amount of soybeans. But, that's been counterbalanced by significant demand to China. China has been importing U.S. soybeans at a record rate throughout the winter and as we're entering into 2017. So that's, provided a good balance for the overall market. Considering the market is needing to see that continued demand to provide that balance, all of a sudden, if Chinese exports are coming into question, then that balance could be, taken away, and we could see some significant downside given the kind of supplies that we currently have in the market.
Is now the time to sell some 2017 soybeans then?
That's a good question. There's a lot of ways that you can do that. We actually like selling new crops. So you can, in futures, you can sell a forward contract farther in time that will reflect next year's yield. We think there's an opportunity in selling new crop versus what they call old crop, which are basically soybeans that are currently in reserves right now.
Where else are you looking then for buying opportunities or indeed selling opportunities within this space? How are you positioning yourself for the months ahead, given, as flagged, some of those concerns that we do have over trade spats, as it were?
Well, I mean, as it relates to the grain markets, I mean, if you're looking for a directional market opportunity, I think any rallies that we see should be sold. I mean, at the end of the day, we have a lot of soybeans in current supplies. I was looking at some numbers. Given the fact that soybean prices on a relative basis to corn have held quite strong, it gives farmers this year a strong incentive to plant more soybeans. And if we add 6 million acres of soybeans, that would leave us with an all-time record supply of soybeans, in our supply chain, which is obviously very, very bearish. So, I think any kind of short-term situation that allows soybeans to rally, I think those rallies should be sold looking for a longer-term short-side opportunity.
Tim, we will leave it there. Thank you so much for your time today.
Thanks, Natalie.